Hi, I'm Nikhil Vachani from Phoenix Financial Training from the CFA Simplified team. Today we're going to discuss about one of the topics regarding pensions, which not only talks about what is the pension scheme, but also how do we account for it. One of the pension schemes that we have is the defined contribution scheme. Before that, let's try to understand what do we really mean by pensions. Pensions is a way of saving up for retirement. It is a way that the employers help you save up for your retirement. The process that works in most pension schemes or most countries around the world is you have the employer as well as the employee contributing a percentage of their salary into the pension fund. So the employer will deduct or put in some percentage of the salary. So not only they will deduct the money from the employee as part of the employee's contribution, but also contribute some element on their behalf from their own pockets into this pension fund. So the employer will put in the money, so is the employee. But let's focus on the accounting from the employer's perspective. So the employer is contributing into the fund. This pension fund is a separate legal entity run by fund managers, whereby they invest these funds in different things, in fixed deposits, a bit of mutual funds, and various investments they have. And the way the process works, it's the pension fund that pays out the employees from the date they retire till the date they die. What we need to understand is one kind of this scheme known as a defined contribution. What does defined contribution mean? Is the amount that is being contributed into the scheme by the employer is already fixed. It is predetermined. For example, it would be the employer promises to contribute 10% of the employee's salary into the pension fund. One of the features of this scheme is the amount contributed by the employer is fixed, but the amount that the employee will get once they retire depends on the fund's performance. Hence, the risk with this scheme lies with the employee. How much they get paid out, whether they get paid out more, lesser, depends on the performance of the fund. From an employer's point of view, it is very nice because the accounting which I will show you is pretty straightforward. The risk is pretty less. Whereas for the employee, it's slightly more riskier because the amount they will get is a bit uncertain. How do we do the accounting for such schemes? As per the IS 19 standard, which teaches us that these contributions that the employer is making is nothing but an extra expense for the employer. It's an extra remuneration for the employer, that it is a part of the remuneration expense. So when you hire an employee, not only do you pay them the salaries, the bonuses, but this pension that you're contributing is an additional cost for you. Hence, this additional cost is recorded as an expense. When you record this expense, not only is it reflected in your profit and loss or your income statement, but there are additional disclosures that are required as well. Let's look at an example to prove what I said. In this example, we have this entity Max Company, which is agreeing to contribute 6%. So fixed amount they are agreeing to contribute into this pension scheme. The amount of contribution could be on the basic salary, total salary. In this example, it's on the total remuneration, which is 24 million. 24 million is the total amount to be, or the total remuneration for this period. The amount to be contributed is 6%, which is 1.44 million is the amount of expense that will be recorded. So irrespective of how much is being contributed, 1.44 million will be recorded as an expense. The fact that you are actually contributing, the employer is only contributing 480,000 into the plan, that 0.48 million will be a reduction from their cash flow. For those who like debits and credits, debit expense, credit your cash flow, and the balance is reflected as a payable or a liability from the employer's point of view, or a payable or an accrual, you can call it, of 0.96. So to sum up, we have fixed amounts to be paid, risk with the employee, accounting of it is recorded as an expense, any amounts not yet paid to the pension fund is recorded as a liability.